Hey, what's up? It's Ben here. So if you have ever traveled to a different country or bought items from across the border, there is a high chance that you have participated in Forex. Now, the name Forex might sound complex at first, but it is simply short for foreign exchange. So it basically means exchanging the currency of one country with another. Let's say that you're an American tourist traveling to France. You will be carrying the US dollar with you since it's the currency that you use in the United States. But if you try to buy anything with the US dollar in France, chances are that they won't accept it. To become a friendly tourist, you want to buy things in the currency used in France, and that's in euro. An interesting fact about the euro is that 20 European Union countries use it as their official currency. So if you're traveling to some European Union nation like Germany, Italy, Finland, Ireland, you want to carry the euro with you. But anyways, after you have exchanged your US dollars with euro, you have officially participated in the foreign exchange or the Forex market in the most basic sense. To trade in Forex, you might buy physical notes and exchange them when the currency value goes up to make a profit. That is one way of trading in the Forex market. However, you can trade Forex in bulk and in the comfort of your home through various online platforms and mobile apps with the help of Forex brokers. If you just do a Google search, you'll find a ton of them out there. Like the stock market, Forex has a market where you can exchange currency. Since currencies from all countries can exchange in the Forex market, it's a global market. You will buy a currency in exchange for another currency and vice versa. Therefore, the Forex market is decentralized, meaning that there isn't a central exchange where all the transaction occurs. Instead, all trades happen electronically through a network of banks, brokers, and other financial institutions. This means the market opens 24 hours a day, 5 days a week, and you can be trading from anywhere in the world. So that means the Forex market is pretty huge. In fact, it's the biggest financial market in the world with over $5 trillion traded on a daily basis. So how are the values of the currencies calculated in the Forex market? First things first, you will need to have two currency pairs with the value of one currency relative to another. For example, the Euro-USD pair represents the exchange rate between the euro and the US dollar. Calculating these values can be overwhelming at first, but to understand it in simple terms, it shows how many US dollars are needed to buy 1 euro. So if the value of euro-dollar exchange rate is $1.10, then you will need 1.1 US dollar to buy 1 euro. This means the euro is stronger relative to the US dollar and worth more than the US dollar. You might be wondering, on what basis do these currency values fluctuate? Now, various things affect the currency rates, and it's changing every second. Since it's actively traded in the foreign exchange market, its value are determined based on the supply and demand of the currency. And now you might be asking, what affects the supply and demand of the currency? Well, there are many things. To name one, the interest rates of the home currency affects its value. For instance, if the interest rates in the US are higher than Australia, more people will certainly want to buy the US dollar because they will get more interest for putting their money in the US bank. This means the demand for US dollar will be higher, boosting the currency's value. Some other factors that affect the supply and demand for the currency could be the inflation rate, government debt, central bank policy, and the country's economic performance. After learning all this, you might be wondering why Forex even matter. Well, it's crucial for many reasons. One reason is that it allows smooth transactions of trading conducted internationally. The smooth functioning of a Forex market actually makes it easier for countries to trade with multiple countries since it opens up access to buy and sell international currencies. Similarly to countries, businesses and investors can use Forex to invest in foreign markets. This way, Forex increases access to other investment opportunities, and speculative investors who look to profit from the fluctuation in the value of the currencies can actively trade them. In order to do that, they can use fundamental analysis and technical analysis. These two types of analysis can help an investor or trader to speculate the value of currency pairs and their future trends. To better understand the fundamental analysis in simple terms, it involves analyzing the state of the country's economy and political factors affecting its future. And you might be thinking, what does politics have to do with the currency value? Well, it affects currencies directly and indirectly. For example, if a populist politician is in charge charge of policy making, then they can take policies to reduce interest rates to gain voters' confidence. Well, this can have catastrophic consequences on the currency as it can make it weaker with low demand. Now, on the other hand, technical analysis includes looking at various price patterns in the chart using various tools to analyze past trends and predict the next price movement. This is more for day traders, but I won't be getting into the details with that in this video. Both strategies can be challenging and comes with their own risk. They both have their own advantages and disadvantages. Likewise, some traders can be good at fundamental analysis and some might be good at technical analysis. Therefore, it is very important to remember that Forex trading and the Forex market can be extremely risky, and it is important to take the necessary steps to understand the market before jumping right in. That pretty much sums up the basis of Forex. To recap what we learned, Forex involves exchanging one currency for another in the global market. Various factors like interest rate, a company's economic performance, and inflation can all affect a currency's supply and demand, ultimately affecting the price. The Forex market is extremely important for international trades, and speculators are always around looking to profit from trading Forex. Lastly, it's important to understand the ins and outs of Forex trading before actively trading or investing in the Forex market. So now, hopefully you can answer the question, what is Forex, when someone asks you. And if you have any questions, feel free to drop a comment down below. And if you found this video to be helpful, feel free to give it a like and maybe consider subscribing for more weekly uploads like these. And I'll catch you later.